I built a macro model to predict the all-time high price of Bitcoin in 2025, and the results absolutely shocked me. After weeks of analyzing data, tracking economic signals, and testing countless scenarios, the model just outputted something I never expected. What exactly did it reveal, and what does it say Bitcoin will do in 2025? In this video, I'll be sharing the surprising results, breaking down exactly how this model works, and sharing why I believe that this model might actually be onto something, and if true, it has huge implications for Bitcoin's price in 2025. I've spent years trying to figure out what causes crypto boom and bust cycles. If you don't know, every 4 years, crypto repeats the exact same playbook like clockwork. 2013, you had an insane bull run. 2014, you had an insane crash. 2015 through 2016, you had a consolidation. 2017, you had an insane bull run. 2018, you had an insane crash. 2019 through 2020, you had a consolidation. 2021, you had an insane bull run. 2022, you had an insane crash. You get the picture. Like clockwork, for some reason, crypto has followed this very distinct 4-year pattern. And right now, everyone else says that the reason we get these very distinct 4-year cycles is because of the Bitcoin halving and because of simple supply and demand economics. This is why we see this 4-year cycle, which I don't buy it. I don't buy that the halving is the reason we have these crazy crypto boom and bust cycles. Because if that was true, then when Ethereum had its merge and cut its supply by over 90%, we should have seen an explosive move up in Ethereum's price due to the simple supply and demand economics that everyone else says is responsible for these massive crypto boom and bust cycles. But we didn't see anything even remotely close to that. As more time has gone on, more and more evidence has stacked up to seem to suggest that the Bitcoin halving has very little to do with what ultimately causes the 4-year cycle. And if that's the case, then what is the true force behind crypto's 4-year cycle phenomenon? What is the thing behind the scenes that's pulling the strings, causing these crypto boom and bust cycles to repeat exactly every 4 years? That's the mystery that I've been obsessed with for years. But recently, my obsession became urgent as we watched the 4-year cycle pattern seemingly falter earlier this year and not play out as expected. Because of this, a lot of people were saying that the 4-year cycle is now broken. That's because 2025 was supposed to be the year. It's supposed to be the year of the insane bull run. It's supposed to be our 2021 or our 2017 or our 2013, the year where crypto assets go absolutely crazy and everyone makes a ton of money. But now everyone was asking themselves, what if it's not coming anymore? What if the mysterious force that causes this 4-year cycle is now broken or it's changed? And being that I have 100% of my net worth in crypto, I needed to know for myself if this was true or not, which meant that I needed to actually figure out what was causing the 4-year cycle in the first place. And I decided the best way to solve this mystery was to try to build a predictive model that accurately forecasts the all-time high for Bitcoin any given year. The idea being that if I could correctly identify the data points that predict crypto's boom and bust cycles historically, then those data points would likely be the true culprits behind the 4-year cycle in the first place. My rules were simple for this model. I would use rigorous backtesting standards to avoid what's called overfitting, or basically overtuning my model to the historical data. All my formulas in the model had to apply generally to the entire backtesting period, meaning no tuning certain time periods and never individually yearly adjustments. I'd ensure no data leakage. All predictions had to be from the first of any given year, using data from that day or before, never any data after. Lastly, only top quality data inputs. I had to source only clean price and macro data to input into the model. To start off, I gathered all the conventional theories behind why the 4-year cycle exists, and I started to sift through them. First off, you have Bitcoin's halving cycle. We already talked about this. This is the most commonly contributed reason for the 4-year cycle. Second, you have the kitchen cycle or the short business cycle. Basically, some people believe that crypto's 4-year cycles is because of this kitchen cycle, because of this short business cycle. And that's because Bitcoin often peaks when macro liquidity tightens and bottoms when it loosens, in line with these kind of mini boom and bust waves that come with this kitchen cycle. Third up is the political election cycle. The idea being that before an election happens, the people in power pump a lot of stimulus into the economy because they want things to look good so that their party gets reelected. And the overall idea being that each individual year, there's a unique set of incentives that cause the person in power, the party in power, to do certain things when it comes to liquidity, and that those things, this is the theory, are responsible for the 4-year cycle. And obviously, the political election cycle is also 4 years, so these things seem to line up. Then there's the theory around the solar activity activity cycle. Basically, you have this full sunspot cycle that's 11 years, but it has these mini cycles that range from 3 to 5 years. And the theory is that this solar activity affects human mood, it affects market volatility, it affects weather and productivity, and all these things kind of play into why we have a 4-year cycle like we do. Finally, you have the self-fulfilling prophecy theory. Basically, because people expect a 4-year cycle to happen, they sort of make it happen because every 4 years, around the time that they expect it to go up, they start buying. This causes the frenzy, pushes prices up, and causes the mania that they expect. And after looking through all these things in detail, I personally felt like any one of them could be the true culprit behind the 4-year cycle. The only one that I outright ruled out was the solar theory. That one felt a little bit too out there for me, but the rest of them seem to have a solid case for why they could be responsible for the 4-year cycle, or even more likely, perhaps all of them, or certain, combinations of them were the reason we had the 4-year cycle. So I started breaking down each one of these theories, dissecting how they worked, and then sourcing macro data related to each one to put into the model. And this was an extremely complicated process because you have to find data points that are truly predictive of something that will happen versus data points that show what happened after the fact. Now, originally, when I built this model, I used the 4-year cycle in my original version. And basically the idea being that, with the 4-year cycle incorporated, the model knew, hey, this is a bullish year, this is a bearish year, this is consolidation year, bullish year, bearish year, you get the idea. That allowed the model to be insanely accurate. And remember, the model's goal is to predict the all-time high price of Bitcoin any given year. And knowing what years were bullish and what years were bearish was a massive advantage. But then once I had gotten the model tuned to a baseline of sorts, I removed the 4-year cycle from the model, leaving almost sort of like a hole in the model, with my goal being I would take various things and try to stick it into that hole to see if it was a good replacement for the 4-year cycle and see if it could get the model back up to the baseline. And whatever thing could get the model back up to the baseline was likely the true culprit behind the 4-year cycle. At the same time, though, again, being hyper paranoid, making sure I wasn't overfitting to historical data. And the more I dug deeper, the more I became convinced that liquidity was truly one of the core drivers behind the 4-year cycle. And that's because every single bull market and every single bear market seemed to have really clear as day liquidity catalysts that were driving the outcomes of those periods. For example, when looking at the 2013 crypto bull market, you had first off the Fed doing a ton of QE in late 2012. That's like massive amounts of liquidity coming into the market. The Fed funds rate was basically at zero. That leads to cheap credit. Cheap credit leads to money creation. Money creation is liquidity. And you in general had low rates globally. So everyone had really cheap rates, all this abundance of credit, and that's leading to a lot of liquidity creation. The 2017 bull market also had very specific catalysts. First off, even though the Fed was raising rates were really, really low. They were sitting at around 1%. The 10-year was also sitting really low, and both these things, the Fed having low rates, the 10-year being low, lead to abundant credit, and abundant credit leads to money creation. But the biggest catalyst for 2017 was dollar strength dropping. So we saw a massive plummeting of dollar strength, and that has a huge impact on global liquidity. And obviously, the 2021 bull market was famous for the insane amount of liquidity that was injected into the markets. We just had tons of money printing. We had insanely cheap rates. We had stimmy checks. I mean, we had everything. Everything was happening all at the same time. It was just a hailstorm of just liquidity into the markets, which massively pumped everything up. Now, looking at the bear markets, they also have really clear liquidity retraction events that cause those to happen as well. And maybe most important of them all is the fact that, when something runs up, like when crypto goes super high, when Bitcoin goes super high, you have a lot of leverage that enters the system. It gets really unhealthy, and you're just going to have a retraction event that follows that because of that. When something goes crazy, up a 10x, 20x, or something like that, the amount of leverage that enters the system means that you're going to have an unwinding of that leverage. So first and foremost, that's a massive catalyst event right there for a retraction in liquidity. But also outside of that, in 2014, you had the Mt. Gox collapse. You had a crackdown from China. You had the Fed ending QE. You saw dollar strength start to rise. In 2018, the Fed hiked rates 5 times. QT began, more and more crypto bans happened in Asia, and the dollar strength rose. In 2022, we had the fastest Fed hiking cycle ever. Dollar strength hit 20-year highs, and QT went into overdrive. So again, as you can see, really clear catalysts for both the bull and the bear markets every single year. So I shifted my focus to finding the right data points that were predictive of liquidity any given year. I ended up incorporating this macro model into the Bitcoin model, and it vastly improved the accuracy, but it was still a far cry from where I had things when I incorporated the 4-year cycle. Things were seemingly going great, and I thought, I must be just a couple tweaks away from fine-tuning this model to be hyper accurate. I must have discovered the secret ingredient, the mysterious force behind the 4-year cycle. But unfortunately, that just wasn't the case. No matter how much I fine-tuned things, no matter what changes I ended up making, I could not push the model accuracy any further. And I'd apparently hit just a solid wall of resistance where no matter what I did, no matter what I tried, no matter what ideas I came up with, nothing seemingly improved the model further. It appeared that although I had identified correctly some of the drivers behind the 4-year cycle, I was still missing the core ingredient responsible for causing the 4-year pattern. Although liquidity was certainly like a main ingredient in like what causes the 4-year cycle, liquidity itself was being driven by another force. Another thing was causing these liquidity cycles that we were seeing across the 4-year cycle. But I ended up getting another idea or another way to attack this problem. Basically, my thought process was if the 4-year cycle exists, if there's this 4-year crypto cycle, and this is based off of some sort of liquidity cycles, then shouldn't that mean that there's other cycles in like other markets? Like crypto shouldn't be the only one that has cycles. If that's the case, there should be other cycles that exist in the wider market that are maybe playing a role in the crypto cycle or maybe just fully outright responsible for the crypto 4-year cycle. And this led me down a strange rabbit hole of like the wider economic theories behind these like other cycles that exist in the market. First off, you have the business cycle, which typically lasts around 5 to 10 years, but varies. It has different phases like expansion, peak, recession, recovery. It's typically driven by consumer demand, investment, government policy, and inventory adjustments. You have the credit cycle, which I just did a video on in depth, which is really, really interesting if you want to check it out. This is typically a 7 to 15 year cycle. It has multiple phases as well. You have an expansion period, a euphoria period, a tightening period, and then a deleveraging period. You have the monetary policy cycle. This is typically a 3 to 10 year cycle, and it's dependent on central banks. You have psychological/sentiment cycles. There's no set specific time period for these cycles, but it does follow a very particular order. You have euphoria, complacency, anxiety, capitulation, depression, hope. Most people are aware of this cycle via the psychology of the markets chart that I'm sure you've probably seen before. You have the liquidity cycle. This typically has 2 to 4 year mini waves and is dependent on central banks, fiscal spending, dollar strength, etc. You have the kitchen cycle, which we talked about earlier. It's typically 3 to 5 years in length. You have the real estate cycle, which is typically an 18-year cycle, which has, again, 4 different phases: expansion, boom, crash, recovery. You have demographic cycles, which typically last 20 to 40 years. This is actually one of my favorite cycles to look at for the long-term picture of crypto. By and far, the people that invest and buy crypto are the younger generation, and by and far, the younger generation has the minority of the wealth. And over the next 10 to 20 years, something like $70 trillion worth of wealth is going to get passed down from the older generation to the younger generation. And I believe this is going to be a huge long-term catalyst of crypto adoption. You have the commodity super cycle. This is typically a 10 to 30 year cycle that's driven by infrastructure buildouts, industrial demand, underinvestment in supply leads, and emerging market growth. You have the jugular cycle, which is typically a 7 to 11 year cycle. And this is like business investment in things like factories, data centers, infrastructure, turning profit from that, getting that profit and reinvesting it, continuing to expand, eventually becoming oversaturated, and then having to cut back. You have the innovation cycle, which is typically a 40 to 60 year cycle. Basically, think of like how the Industrial Revolution like flipped the whole world on its head. It destroyed a bunch of jobs, a bunch of industries, while creating at the same time a bunch more. Think about the internet when it came and it destroyed a ton of companies while creating a bunch more. Think about what AI is going to do, destroying a bunch of companies while creating a bunch more. And finally, there seems to be this like mega cycle of sorts. I call it the omni cycle that encompasses all of these things and works over an incredibly long time frame. And I got to tell you, jumping into this cycles theory was just wild. There's a lot of historical precedents for a lot of these cycles. It's just weird to me that so much of the market seems to repeat in patterns. So much of history seems to repeat in these very distinct patterns. I don't know. I guess for me, it's just weird. It's just weird that that there's so many distinct patterns. I guess that's the only thing I can say. It's weird. It was in this research process, looking through these patterns, that I finally had a breakthrough from a couple different angles that finally allowed my model to succeed. And the mysterious force behind the 4-year cycle, the thing driving it forward, seems to be more of a combination of a lot of different factors rather than one particular thing. I narrowed the core drivers down to a combination of dollar strength, credit cycles, liquidity cycles, election cycles, innovation cycles, and specific psychology catalysts. With the 2008 financial crisis acting as the initial catalyst for many of these factors to sync up in such a solid pattern, and the halving also playing a smaller role in helping push things along. There is no single catalyst that's responsible for the 4-year cycle. The closest thing you get is the 2008 financial crisis. This spawned very specific reactions and a very specific set of psychology catalysts, along with a set of policies that enabled this pattern to play out in the first place. This means basically that the pattern will become less distinct the further we get away from 2008. Think of it like throwing a rock into a lake. When the rock first hits, the ripple effects are really distinct. They're really like consistent. But the further you get away from the center of that rock hitting the lake, the more like wavy and weird and kind of out of sync they get. Although there is an argument to be made that 2020's COVID crisis may have caused a similar effect that restarts that pattern all over again. Now, I'm sure what you are wondering and what you're waiting for is, what does the model predict for 2025? What is the actual prediction this model is spitting out for 2025? Currently, the model for 2025 predicts an all-time high of $169,771.09 for 2025. And remember, the vast majority of where this model errs or where it struggles is that it underpredicts Bitcoin's price moves up. Specifically, 2023 and 2024 because of the new introduction of ETF flows and ETF hype, which historically has never existed before. That being said, I still don't think you should put a ton of faith into this model. Although I put a lot of work into this model and I really tried my best to make this as accurate as possible, as far as forward testing goes, this model is still new and unproven. And as I mentioned before, one of the main purposes and main goals of this model was to help me research and understand how the 4-year cycles work in the first place. I'm going to continue to work in this model and fine-tune it for accuracy, although I've come a long way. So far, there's still a lot to work on, a lot of nuances to adjust and fill in as time goes on. If you're interested in joining the Obsidian Council, it's currently closed to new members, but you can join the waitlist in the description of this video. In the Obsidian Council, I do weekly market and macro updates. I share my entire portfolio, update every time I buy and sell. I do monthly market deep dives, weekly Q&As, and a ton more. Again, you can sign up in the description of this video. As always, none of this was investment advice. I'm not your financial advisor, and you should always do your own research. If this video was helpful, make sure to hit that like button. If you have any questions or comments, let me know in the comment section down below. And if you want to see more videos like this, make sure to hit the subscribe button and the little bell next to it to be notified each time I release a new video. Thanks for watching, and I'll see you next week.